Greetings to all the learners of this particular course of the University, Principles on Practice of Insurance. This session will be on what is an insurance contract and what are the principles which are governing the insurance contracts which are there. Let us have a brief understanding of what is an insurance contract. Insurance contract is a contract in which one party, which is called as an insurer, is accepting the insurance risk from the other party, who is called as the policy holder. The person who is accepting the risk from the other party agrees to compensate to the other party in case any specific uncertain event happens which brings about some kind of a damage or a loss to the policy holder. Let us have a detailed understanding of this very technical definition. Insurance contract is basically a contract between two parties. One party called as an insurer, which is usually the insurance company, which is accepting to compensate the other party for the risk involved there. The other party is called as the policy holder, who takes insurance policy from the insurance company so that he gets compensated for any kind of a loss or a damage which may happen because of the risk which is being involved in the transaction. Now, this insurance company gives assurance to the policyholder about compensating the losses in case the policyholder suffers any loss. This arrangement is called as an insurance contract. So, an insurance contract is nothing but a contract in which an individual or an entity, it can be one consumer like you and I, or it can be a company entity, which is going to get some kind of a financial protection or a reimbursement from the insurance company in case the entity or an individual is suffering any kind of a loss or a damage which can be there. So, one party is undertaking to compensate the other party for the risks and the losses which may be suffered to the other party on happening of a future uncertain event. This is what is an insurance contract. One party called as insurer provides compensation to the other party called as policyholder in case this policyholder suffers any loss or a damage on account of happening of a future uncertain event. So, these are some parts which are involved in the definition. Parties, insurance company called insurer, policyholder called insured. Company compensating for the damages, losses suffered by the insured. Why will insured suffer any losses? Because there is some kind of a future uncertain event which is going to happen, which will bring about damage or a loss to the insured, which is called as a policy holder. This insurance is a contract, and in India we define all the contracts according to Indian Contract Act 1872. This Contract Act says any agreement can be called as a contract if it has certain features to it. Insurance also can be called as a contract if it has got certain essential features to it. So, let us have an understanding of these features along with definition of some terms which are involved, because this is a little technical in nature. Let us first have an understanding of some definitions. First definition is insured event. Future uncertain event which will bring about loss or a damage. So, there should be happening of a future uncertain event. Insurance company is providing cover if that future uncertain event happens. For example, if I take medical insurance, the future uncertain event is that I have to fall sick. I may be hospitalized for me to take benefit under the medical claim. So, the future uncertain event there is hospitalization on account of sickness. Or a businessman can take fire insurance for his godown, where the future uncertain event can be a fire which may break out in the godown, because of which he will suffer loss or damage, and the insurance company will pay insurance compensation to him. So, here the definition of insured event which is a future uncertain event. If it happens, loss or damage will come to the policyholder and insurance company will compensate to the policyholder in case the event happens. That's the first term. Second term is insurer. The party which is taking the obligation of compensating for the losses or damages suffered. Basically, the insurance company is the insurer who is insuring the policyholder that if you suffer any loss or a damage, we are there to compensate you for that. That is called as insurer. Then you have insured. The policyholder who takes insurance policy for compensation against any losses is called as the insured. If I take a life insurance policy, then it is an individual who is taking insurance, so individual is insured. If I am taking a fire insurance policy on the goods that I have in my godown, then the insured is the business which is taking the fire insurance policy there. So you have insured, insured event, insurer, insured. Then you have another definition by a term reinsurance. This particular insurance company, which is called as insurer, who is actually giving compensation for damages, they also should receive some kind of a protection from somebody else. So reinsurance basically is an insurance contract which is entered into between two insurers, company and another company. So one company is giving insurance to another insurance company which is giving insurance to individual policy holders. So this is reinsurance. Basically in India, general insurance company is the company which is a reinsurance company. So all the insurance companies will get the contracts of their insurance policies reinsured through the general insurance company. So therefore them you call as your reinsurer. Point to remember here is reinsurer will not have direct dealings with individual policyholder. Reinsurer has got a contract with the insurance company, which is the insurer. So reinsurance is a contract which is between two insurance companies. One insurer, which is called reinsurer, who is trying to compensate another insurer, which is called as a cedent. In case losses are there on one or more contracts, if on some insurance contracts, if the insurance company has losses, they can get those contracts insured by another insurance company who is called as the reinsurance. This is also one aspect in insurance. So insured event, insurer, insured, reinsurance. These are the basic terms which we have to remember when we talk about an insurance contract. Insurer, company which is issuing insurance policy promising to compensate for losses or damages suffered. Insured, policy holder who is getting the insurance compensation for losses or damage suffered by him. In reinsurance, where you talk about one insurance company taking insurance from another insurance company in case more losses and damages are suffered by them. Then event, future uncertain event because of which the damage or a loss may come. These are the four basic terms to remember when you talk about an insurance contract. Because it is a contract, it has to have certain features to it. So let us now concentrate on the features of an insurance contract which are there. The first feature is insurance contract is a contract of aleatory. Aleatory is aleatory concept in an insurance contract is something where one party to the contract may receive consideration more in value than what he or she will give up under the terms of agreement. For example, you talk about the policy holder who will have a sum assured related to the policy. The actual loss which may be suffered may be something, but the claim that he may be getting may be more than that or less than that. So you have one party which is gaining, one party which may be suffering a little bit of loss. So insurance contract is an aleatory contract. For example, if I take an insurance policy for 1 year and at the end of the 9th month I am suffering some damage. So I have completed payment of premiums for 9 months. The damage comes in the 10th month. but in the 10th month 2 more months are left for premium to be paid, but damage has already come, so insurance policy will have to pay me in the 10th month itself because the future uncertain event happened and they have to compensate me for the uncertain event because I suffered damages. So what I am receiving is more than the premiums that I have paid. I paid only for 10 months, damage occurred in the 10th month, so whatever was the sum assured, they have to pay me that sum assured. So what I am getting is more than what I actually have paid. This concept is called as aleatory concept. So I am at a benefit. Sometimes company is at a benefit. I took an insurance policy for 1 year, I paid premiums all 12 months, no uncertain event happened. So I ended up paying premiums then. So for example, medical insurance, we basically have, I don't suffer any hospitalization for 1 year, but I have paid all the premiums for full 1 year. So next year when I go for renewal, I cannot say that I paid premiums for last year and I didn't claim hospitalization, so you continue. You have to renew your contract and start paying premiums afresh. So this concept is called as the concept of aleatory, where in a contract one party may receive considerably more in value than what one party may actually give up. That is first feature. Second feature is the feature of adhesion. Feature of adhesion here says one party draws up the contract in its entirety, presents it to the other party and tells the other party, take it or leave it. Insurance companies draw the entire insurance contract, they present it to us, explain the terms and conditions, tell us how much we have to pay, when do we have to pay, how much bonus they will give us, how much compensation of loss will happen. All these terms and conditions are written by the insurance company and presented to the policy holder. If the policy holder agrees to the terms and conditions, he will take the policy. If he doesn't agree to the terms and conditions, he will leave the policy. So this concept is called as the concept of adhesion, where one party frames all the terms and conditions of the contract, presents it to the other party, and the other party has a choice of either taking it or leaving it. Say for example, if I buy medical insurance, the company may say, we will reimburse your hospitalization charges only to the extent of 80%. 20% you have to pay from your pocket. So what happens there? The contract is already drawn by the insurance company. I either take it or I leave it. This concept in the contract of insurance is called as the concept of adhesion. Third concept that you have is the concept of executory, where the parties to the contract have to execute the contract completely in order to avail the benefits of the contract. You cannot have any terms and conditions left unfulfilled or fulfilled partially. If I have to take benefit under the insurance contract, I have to execute the contract in its totality. This is called as executory. Then each of the parties perform their roles and responsibilities respectively. So the contract is unilateral. Company performs their functions and policyholder performs his function. So both will perform their functions exclusively. Then insurance contracts are also conditional, because we say if a future uncertain event happens, if damage happens, only then the company will pay. Here conditions are of two types. You can have a condition which can be precedent or condition which can be subsequent. If I have to claim medical insurance, I have to fall sick. That is condition. If I have to take advantage of my health insurance or of my life insurance, for example, health insurance, that is your medical insurance, I have to fall sick and I have to be hospitalized, only then I can take benefit of a medical claim. Life insurance, there is a clause which says if you commit suicide, then the beneficiaries of the life insurance policy will not get the advantage of it. So that's a subsequent clause which says suicidal clauses in the life insurance policy. If the policyholder commits suicide, then the benefits of the policy may not be transferred. These are conditions which are there in any insurance policy as such. So insurance contracts are conditional. And insurance contracts are personal contracts, because you have insurance company and people who are involved, insurance company or business entities who are involved. So these are all contracts which talk about people. Then insurance contracts have the feature of warranties and representations. It means whoever is the insured, the person taking the policy, they have to provide correct information to the insurance company. Say for example, when I am writing my medical insurance application, I have to inform the company prior hand if I am suffering from any chronic diseases, because there will be a vesting period. I have to inform them correctly my age. Depending on that, the premiums will be fixed. So therefore, all these clauses will be there which will talk about provision of appropriate and correct information by the insured. Same way, insurance company also will have to provide correct information to the insured, saying when will they pay the premiums. It so happens that many frauds have been happening where insurance companies were not processing the claims. So insurance regulator, which is IRDAI, Insurance Regulatory Authority and Development of India, these people have come up with a concept called insurance ombudsman. So if you have any problem with the insurance company, they don't reveal information, they don't process claim, you can give a complaint to the insurance ombudsman. So the feature here of the insurance contract says both the insured as well as the insurance company will have to disclose facts appropriately and accurately when the contract is being entered into. Then there should not be any kind of misrepresentations and concealment. You don't have to conceal any information from the insurance company because it is a contract which is based on the principle of faith. Both the insured as well as the insurance company will have to disclose all the facts related to the insurance contract accurately to each other. So no representations, no concealments in the insurance contract. Insurance also contract has a feature of fraud, where it is an intentional attempt on the part of any party to deceive the other party. For example, when I take a medical insurance policy, the company will have tie-up with hospitals so that I can run a pre-check. When I go for a pre-check of my health, instead of I will send my friend who is more healthy than me. So what am I doing there? I am impersonification is happening here. That is a type of a fraud. So such things should be avoided in an insurance contract. If the insurance applicant is intentionally lying or deceiving with the intention of committing fraud, then the insurance contract cannot be upheld. It is a void contract as such. Similarly, there should not be any kind of a false pretense or any concealment of the facts in the insurance. These are some of the features of insurance contract. To sum up very briefly all these features, first we said aleatory. It means that somebody may receive more than what somebody gives up. Executory, where we said both the parties have to execute all the terms and conditions. Addition, insurance company draws the entire contract and tells take it or leave it. Unilateral, both the parties have to execute all the duties, roles and responsibilities of the contract. Conditional, there are some conditions which are attached. Only if that condition happens, then the insurance claim will be paid. If that condition happens, insurance claim may not be paid. Unless I fall sick, no medical claim. If I commit suicide, no insurance benefit to my beneficiaries. Conditions will be there. Then warranties, misrepresentation, concealment, fraud, impersonification, all this will lead the insurance contract to become invalid. So all these things should be avoided by both the parties when they are entering into an insurance contract. These are some of the features of insurance contract. Now let us see what are the principles which are guiding this entire insurance contract. There are 7 principles which guide insurance contracts as such. The first one is called as the principle of utmost good faith. We have in business law, when we study utmost good faith, which we call as uberimai fidei. That is the foreign word which we use for the word utmost good faith. All the insurance contracts are based upon mutual faith between the insurance and between the policyholder. Whoever is the insurance company, they are having belief that the insurer is providing them correct information. Insured also will have belief that the company is providing them correct information. So that is the principle of utmost good faith. Both the parties disclose every fact which is material and essential to the contract. So the principle of utmost good faith. That's the first principle, where you believe in each other when you enter into a contract and you say that whatever information I am providing is true and best to my knowledge. both the policyholder as well as insurance company. See, insurance company drop the contract, they provide information, how many years, how much premium, how much bonus, sum assured, entire process. So this information they will provide. Insured also will provide information about age, dependents in the family, income, chronic diseases suffered. All these are information which we provide. So both of them should provide accurate information. That is the belief that you have in one another. That is called principle of utmost good faith. First principle. Second principle is principle of insurable interest. Whatever I am getting insured, the subject matter of insurance, that should be of importance to me. When I as an insurance policy holder, I am getting something insured, that should have some importance in my life. If I am a business person, I am getting my goods insured, that should have some importance in my entire business. I should have insurable interest in the life of my spouse or in the children on whose name I am taking insurance policy. If I am a company, I want to take insurance policy on my chief officials like CFO, Chief Financial Officer, Chief Marketing Officer, CEO of the company. Nowadays, companies are taking insurance policy. This is called KPM insurance, key personals who are managing the company. They take an insurance on their life, because if something happens to them, company may suffer losses. This concept is called as insurable interest. Whatever I am getting insured, that should be of relevance to me, that should be of importance to me. If I am getting something insured which is not relevant to me, then insurance policy will not accept my insurance process and application or claim as such. So there should be a principle of insurable interest. An individual has got insurable interest in his own life, in the life of his spouse, in the life of his children. So they have got insurable interest there. That's the second principle. The third principle is principle of indemnity. Indemnity means protection. Insurance company promises to give protection to the insured by providing financial compensation for the losses suffered. So see, protection here is in terms of only compensation. If somebody loses life, you cannot replace that life as such, but financial compensation can be given for the loss which may be suffered. So principle of indemnity says compensating the insured for whatever is the loss suffered by that particular insured, except for loss of life which cannot be measured. All other losses which can be suffered in insurance policy, the actual loss can actually be compensated by the insurance company. That is principle of indemnity. Then you have principle of proximate cause. Proximate cause means what is the nearest cause which has actually caused the damage. So insurance company will have a list of causes, reasons which might have caused the loss. So when the loss is being suffered, if the loss is suffered out of those reasons only, insurance company will provide claim. For example, marine loss, fire insurance. In case the goods got destroyed only by fire or accidental or fire on account of act of nature, fire which may broke out because of some gas emissions, anything, but because of fire the goods got damaged. So fire should be a cause for claiming fire insurance. So that way, whatever is the nearest cause for the damage, that will be assessed by the insurance company, and only then compensation will be paid. This is the fourth principle, which is the principle of proximate cause. The first was principle of good faith, second insurable interest, third indemnity, fourth proximate cause. The fifth one is the principle of subrogation. This principle will apply where an insurance company will compensate for the loss, whatever is being suffered, and then whatever are the rights which are related to the property, those rights will be automatically transferred to the insurance company. So whatever goods were there which got damaged because of some event which occurred, insurance company will pay all the damages, compensation. Now all the goods will then become the property of the insurance company. This is called principle of subrogation, where after the claim is being processed, the property which got damaged will now become the property of the insurance company. So rights related to the property will pass on automatically to the insurance company as such. This is principle of subrogation. Then you have principle of contribution. For example, if a person takes insurance policy of same thing from more than one company, I take insurance policy for my goods from company A, same goods I will also take insurance policy from company B. So to whatever extent I take from A and to whatever extent I take from B, both will contribute together to compensate for my loss. And these two contributions together cannot exceed the actual loss which I suffered. If I took from, say for example, my goods were worth 1 crore. I took a policy from company A worth 80 lakhs, company B worth 30 lakhs. These two put together has become more than 1 crore, but my damage is only up to 1 crore. So they two will come together and appropriately, the proportion of loss that is being suffered, they will assess and then give me compensation. This is called principle of contribution in case the policy holder takes policy from more than two companies. Last principle is principle of mitigation. This is also called principle of risk minimization. It says that whatever could have been the possible measures which can be taken by the insured policyholder to reduce the intensity of loss, that should have been taken. If a fire breaks out, I cannot fold my hands and stand and see that. I have to give immediately a call to the fire station so that the firefighter comes and put out the fire. That is what is the steps taken by me to minimize the loss. So insurance company will assess what are the steps which are taken by me so that I am able to minimize the loss and just not look at the loss actually happening there. This is called principle of mitigation or principle of loss minimization. So insurance company will also check if you have taken steps to minimize those losses which were there. So these are the 7 principles which are there of an insurance contract. Principle of utmost good faith, which says that both the companies will have to have a mutual trust in one another, company and the policyholder, and reveal all the information necessary for the contract. Insurable interest, whatever property or people I am getting insured, I should have some kind of an interest in that. Indemnity, which talks about giving protection for the losses which are there, principle of indemnity. Principle of proximate cause, whatever is the nearest reason for the loss to be suffered, that has to be identified, proximate cause. Principle of subrogation, when the insurance company processes the claims and pays to the policyholder for the loss or the damage, the property which is damaged passes on to the insurance company. It becomes the property of the insurance company. That is principle of subrogation. Principle of contribution, if I take insurance policy from more than one company, both will contribute proportionately for the loss. Principle of mitigation or loss minimization, where I have to take appropriate steps to minimize the loss of when I am taking the insurance contract as such. So this is about what is the insurance contract and what are the various principles which are involved in the contract of insurance. So in this session we have talked about what is an insurance contract, where we said it is nothing but a contract between one party who is called as the insurer and another party who is called as the insured. So insurer will actually promise to pay to the insured any kind of a compensation for any damages, losses which may be suffered on account of a future uncertain event. Future uncertain event must happen. That event should bring about a loss or a damage. Insurance company will assess the loss or a damage and then pay compensation to the insured, who is called as a policyholder. And this insurance contract is like any other contract which is upheld under the Indian Contract Act 1872, which talks about the various features of a contract. And here separately the features of an insurance contract says that it is a contract of aleatory, it is a contract of adhesion, it is a contract executory, unilateral, conditional. It is a contract which should not have any fraud element, misrepresentation, concealments, and any impersonification on the part of the policyholder. Similarly, when you say principles of insurance, there are 7 principles to remember. Principle of good faith, where both of them should have mutual trust among one another, the company and the policyholder. Principle of insurable interest, where whatever policy I am taking on any person or any property, that should be of relevance to me. Principle of indemnity, where the insurance company is actually protecting me against losses. Proximate cost, whatever is the nearest cause which has caused damage, that will be identified by the company. In case I have taken insurance policy from more than 2 insurance company, both will contribute proportionately to compensate to me for the losses which are being suffered. And as a policy holder, I have to take steps in order to minimize the damage that might have been caused in the entire process of loss minimization. These are the 7 principles which are there on any insurance contract. So in this session, we have learned what is an insurance contract, what are the features of an insurance contract, and the principles which govern the insurance contract. Thank you.